Tech stocks feel like a lottery sometimes. You can invest in them with a repeatable method that fits a regular life, not a crystal ball. This approach starts with you. Define your goal and your risk tolerance so you know how much tech you should own. Then build a simple shopping list. Look for 3 kinds of tech: software and cloud, semiconductors or hardware, and AI-enabled services, especially those with strong margins. You don't need every name, just a few with real earnings and growth you can actually justify. Know why you're buying. If you're young with time, you can take more risk, but you should still have a plan in case things get messy. If you're near a goal, keep it smaller and steadier so a bad quarter doesn't derail your plan. Use a simple framework. Start with the business model, look for a durable moat, and check margins and cash flow to see if the company can sustain growth. If you can't explain the business in a single clear sentence, you probably haven't understood it well enough to invest. If the numbers show durable growth and a path to cash generation, you have something worth closer scrutiny. If the product is easy to imitate, the moat is weak and your upside relies on luck, not fundamentals. If customers stay because data advantages, network effects, or high switching costs lock them in, the moat is real and scalable. Look for recurring revenue, sticky customers, and a history of converting growth into cash. Check the money side: growing revenue with healthy gross margins, expanding operating margins, and positive cash flow that can fund innovation. Big debt can explode if rates rise or growth slows, so avoid companies that burn cash while promising miracles. Free cash flow over time is a better signal than a flashy headline or a hype-driven forecast. You can start with big names or boring, steady companies that quietly compound value year after year. If you want less risk, use broad tech ETFs like QQQ, XLK, or the semiconductor-focused SMH to get exposure without betting on one winner. If you want to tilt toward AI or cloud goods, add a focused ETF or a small number of chosen stocks, but keep position sizes sensible. Do quick research by reading the latest earnings report and listening to or watching the accompanying earnings call, especially the part where the leadership explains the driver of growth. Look for a clear growth engine you can describe in one sentence, such as a growing software installed base or a new product that creates high switching costs. Skip the hype and check if the story is supported by numbers that you can verify in the next quarter. Limit per name to 5 to 7% of your portfolio and aim for 4 to 8 names total so you don't overconcentrate in any single bet. Diversify across software, semiconductors, and hardware to balance revenue cycles and supply risks. Keep it simple and set a yearly rebalance to lock in gains and prune what no longer fits your thesis, not what's buzzing online. Use dollar-cost averaging and automatic investments so you stay in the game without trying to time the market. Set a rule to buy monthly and add a bit more on meaningful dips if the thesis still holds, not just because a stock fell. This discipline helps you avoid emotional decisions and lets compounding do the work. Think in cycles: AI adoption, cloud expansion, data-driven services, and the way developers build on top of platforms. An example starter plan could be a $10,000 test, split across 4 to 6 names with clear growth drivers and reasonable risk, based on your risk tolerance and time horizon. Like, subscribe, and comment with your plan.